Hi guys, I'm Billy. I'm turning 23 this year. So I'm a Singaporean residing in Singapore. So I'm currently pursuing my bachelor's in hospitality business in Singapore Institute of Technology. And I'm here today to share with you on the topic of stock picking. So I figured a good way to start off this topic is to give you an analogy of how a stock market works. So a stock market is akin to a business district, and the stocks are like elevators. So there are tons of them, some travels faster, some travel slower, some are able to take you up to higher floors, while others just serve a 10-story building, however with a possibility of new levels being added. So you get to choose which floor you like to board. You are given the statistics of the elevator, the speed, direction, number of floors the elevator has travelled to in the past, and how many people board at the various floors. So other than these, you totally have no clue of the immediate direction, the speed, and number of floors the elevator is going to travel. So what is your end goal? Your end goal is to disembark at a higher floor than that you have entered. So that in a nutshell is basically how the stock market works. So within the stock market, there are different models of leaves, also known as asset classes. So let me just go through a few common ones with you guys. So firstly, there's the common stocks. So these are companies which obtain their revenue from sales, which people have the mindset of wanting to trade with the intention of maximizing capital returns. So next, within the common stocks, there are actually a class of stocks known as real estate investment trusts, also known as REITs. So these companies would actually purchase properties and proceed to rent out the office spaces to shopping malls or even hotels. And the rental each month would serve as a passive income towards shareholders. So REITs usually have a higher leverage or debt as they have higher borrowings from banks to finance their acquisition of spaces. So following that, there's an asset class known as bonds, so whereby they provide a fixed annual interest payment as long as your money is invested in it. So bondholders have no say in the company. It's similar to a legal money lender. So they have the highest priority in receiving their payout should the company liquidate. So from past trends, it's shown that bonds and stocks are inversely related, in the sense that when stocks fall for the day, bonds usually rise, because they are somewhat considered a safe haven. So therefore, if the financial market is looking too bleak, people will go for less risky options, which is bonds, to park their money there. So preference shares are similar to bonds, offering fixed payouts. However, they are traded, so their capital would rise and fall. So they are next in line to bondholders in receiving their payouts should the company liquidate. Exchange traded funds, also known as ETFs, would track a certain market. For example, some would track indexes, some would track commodities like gold or oil. So very similar to index, they track a basket of stocks. So what does this imply? More stocks equals to less risky, because it eliminates the micro risk, for example, per company basis risk, although macro risk is still available, which is an industry-wide kind of thing. So now then, how do you choose which lift to enter? So in the context of stocks, how does one pick stocks? So the journey to picking which lift or stock to enter may be tough. So therefore, there are tools out there to assist one in making the right decision. So news and a company's financial statements are like a map to the treasure. There are mainly two forms of analysis to aid one's stock choice: fundamental and technical analysis. So in fundamental analysis, there's a quantitative and qualitative side. So for the quantitative side, you analyze more the numerical terms, for example, the balance sheet, the income statement. So for the qualitative side, it's more the intangible things, industry trends and outlook. Onto the technical side. So technical analysis, talking about all the ratios, price earning ratios, price book ratio, ROE, inventory turnover, day sales ratio, dividend yield, dividend payout ratio. So similarly, all these are just ratios. They don't mean anything if you don't compare with historically, you don't compare with industry and a benchmark.